What can a loan modification do for me? Well, loan modification, for the first and most important, is actually it stops foreclosures. But loan modification is also indicated when the original loan amount is secured by the residents that has a term that is impossible for the homeowners to make, and thus the resident is at risk of losing their home. And this is what I had said before, when what happens is if you have an adjustable rate mortgage, for example, and your rates have already adjusted, your payments can conceivably double and sometimes even triple depending on what the terms of your original loan was. So a loan modification is basically to go back with the bank and negotiate a better rate and a better monthly payment for yourself. Loan modifications is not the same as debt consolidation. A lot of times with debt consolidation, what you deal with is you're dealing with is unsecured loans, for example, such as credit cards and personal loans that you would get from the bank. With loan modification, it is a secured loan. The security is actually your property. It isn't. A loan modification is also not a refinance loan. With refinance loans, generally, in order to refinance, you have to have some equity in the property. A lot of the people, the homeowners that are in need of a loan modification, have zero or worse. They actually have negative equity, which means they actually owe more than their house is worth. And it's also not a forbearance. And a forbearance basically is not changing the terms of your loan. It is a debt forgiveness in the sense that it's a short-term solution. Basically, what the bank does is they give you a grace period of anywhere between 3 to 6 months to not have to worry about the mortgage. But in the end, the terms are the same, the interest rates are the same, the monthly payments are the same, and actually a lot of times what ends up happening is with a forbearance, the difference in the amount that you pay in the loan gets actually added to your principal. Um, so as a result, it's actually not necessarily the most favorable thing for our clients or for yourself as a homeowner. Um, Instead, what we do is when you are successful at getting a loan modification, what you do is you're getting a long-term solution to a situation that you, for example, if let's say you bought the house at the peak and now the market has dropped significantly, you're resolving that issue so that you can keep this house technically, I guess, forever, until you decide at which point you want to save it. A loan modification, like I mentioned earlier, it is really the crux of it is to try to prevent you from going into foreclosure. A lot of people think that they can get significant principal reductions in the property if they do a loan modification, and actually that's not necessarily true. You can get principal reductions, but generally what the banks do is they have sets of rules where they generally try to reduce your interest rate first. If that doesn't work, then the next step is they'll try to lengthen the amortization time between, for example, if let's say you had a 30-year fix, they'll lengthen it to a 40-year fixed term. And then what will happen is that extra 10 years will actually reduce the amount of payments that your monthly payments that you're making.